It's Friday, March 4th. Thanks for joining us at xm.com. You're watching the Daily Market Comment by Mario Sajgiriakos. I'm Christina Marujos. Russian forces attacked and captured Europe's largest nuclear power plant. A nearby building was set ablaze from the intense shelling, sparking fears of a nuclear disaster similar to Chernobyl, until Ukrainian authorities reported the fire had been extinguished and the U.S. Energy Secretary confirmed radiation levels remain normal. The initial reports of a potential nuclear mishap sent shivers through global markets, setting off a flight to safety with traders liquidating stocks and euro-denominated assets to load their portfolios with bonds, gold, and crude oil. Naturally, all these moves were unwound once it became clear that catastrophe had been averted. Gold and oil prices retraced entirely, while Asian equity markets and Wall Street futures recovered a decent chunk of their losses. The notable exception was Europe, where neither stock markets nor the single currency managed to get off the floor. This is a testament to the uncertainty surrounding the European economy. Euro-dollar dropped like a stone before stabilizing around the 110 region, which is an important psychological barometer for the pair. A weekly close below it could solidify the notion that the bears are in command as the fire sale in euro assets continues. In the broader FX complex, what stands out are the powerful moves in the Australian and New Zealand dollars. These currencies typically trade in lockstep with risk appetite, but this relationship has broken down lately, with the Aussie and Kiwi defying the gloomy mood in equity markets to focus on the relentless rally in commodity prices instead. Their geographical distance from the conflict in Europe may be another variable. As for today, market participants could finally turn their gaze back to economics with the release of the latest U.S. jobs report. Nonfarm payrolls are expected to clock in at 400,000 in February. But the metric that matters most for the Fed and investors is wage growth, which is expected to have accelerated a little in yearly terms. Bets for Fed rate increases have been wound back after the Ukraine crisis. Fed officials won't be happy to tighten into a geopolitical crisis, but with an unemployment rate below 4%, rising participation, accelerating wage growth, and mounting signs that inflation is headed even higher, the Fed may not have much of a choice but to slam on the brakes. Another solid jobs report today could make this clearer and keep the wind in the dollar sails. This was the Daily Market Comment. Thanks for watching at xm.com.